Your brand new iPhone deserves the best protection, and the iLune 3-pack screen protector plus 3-pack camera lens protector has you covered. Don't take risks with your iPhone. Click the link in the video description to shop now on Amazon.
Bitcoin's decoupling from traditional markets is becoming increasingly visible as global capital stress intensifies. A resurgence of tariffs, elevated interest rates, and softening corporate earnings have introduced renewed volatility across equities and credit markets. But amidst this chaos, Bitcoin's price is gaining ground, driven by its fundamentals rather than the whims of geopolitics or trade policy. Bitcoin's movement is not erratic. It's not detached from reality. It's increasingly independent, not just in terms of asset performance, but in the forces that drive it. It's behaving less like a high-beta equity instrument and more like a structurally differentiated asset. The implications for corporate finance leaders are significant, as Bitcoin's evolving risk-reward profile diverges from traditional assets. For example, gold remains a stable store of value, while Bitcoin's volatility makes a strong case for holding both, according to Jurian Timmer, Director of Global Macro at Fidelity. The Sharpe ratio now exceeds most traditional asset classes, including U.S. equities, global bonds, and real assets. This suggests that, on a risk-adjusted basis, Bitcoin continues to outperform, even through cycles of stress and recovery. But what's driving this shift? It's the fact that Bitcoin is structurally unaffected by trade friction, monetary tightening, or sector rotation. It operates outside of the same loop as traditional assets, with its volatility not derived from corporate earnings, GDP trends, or policy cycle of any single nation. Its value is not impaired by negative earnings surprises or declining consumer confidence. This introduces a type of capital exposure that's orthogonal to the typical treasury framework. Bitcoin's independence is not perfect, nor is it permanent, but it's structural, not speculative. It has no earnings, no tariffs, no boardroom, and no monetary authority. In effect, it's a monetary instrument immune to many systemic pressures facing public companies. For corporate leaders focused on long-term capital strategy, this independence is not a bug, it's the feature. As capital becomes more politicized, inflation more entrenched, and traditional reserves more correlated, Bitcoin's differentiated profile becomes not just defensible but strategically necessary. The distinction between these exposures creates layers of correlation between a company's income, reserves, and cost of capital, all driven by the same set of macro conditions. Bitcoin operates outside this loop, offering a unique diversification opportunity within a corporate balance sheet. Its growing independence from traditional markets is not just interesting, it's essential for companies looking to build a resilient portfolio.